Good morning, everybody. Yeah. Let me start by talking about the major publication that the OECD produced about a month ago, which is the interim economic outlook. It's basically an update we do 4 times a year, and this time was in March. The interim version is only focusing on G20 countries and on key variables. And I will just set the stage for the assumptions that we used for this set of projections. And obviously, as everybody can imagine, that the starting point was a huge increase in energy prices. Basically, in this slide, you can see the peak, the spikes in crude oil, oil distillates, and gas. So especially for oil, the increase was very impressive. And this was basically because the other producers in the world didn't have a spare capacity to compensate for the stop in exports from the Middle East. What happened basically is an increase in business cost and in consumer price inflation, with adverse consequences for growth, as you can imagine. So to understand better why the energy prices increased, this slide is about the importance of the Strait of Hormuz. And on the left-hand side, the green part is the importance of the Middle East. So basically 2/5 of the global exports of crude oil are originated from the Middle East. So you can imagine how important it was when the maritime transportation stopped. And on the right-hand side is the percentage of global trade for oil and gas going through the Strait of Hormuz. And in comparison, you can see the Suez Canal, for instance, and which was having some issues as well. I think was 2 years ago somewhere. And so the Strait of Hormuz is way more important. And so you can see that 25% of global trade for oil going through the strait. When we set up our projections, another important aspect was the decrease in effective US tariffs. Even though they remain way above where they were at the beginning of 2025, following a decision by the Supreme Court, the effective tariff rates decreased significantly in mid-February. This was a decline which was happening for all partners, but especially for some emerging market economies. And so it's basically India, Brazil, and some of course China and other Asian countries like Vietnam or the Philippines. And this was basically a reason why we were somewhat optimistic before the conflict started. So in this slide, you can see a comparison between the official projection that we produced a month ago. So the solid line is what we think is the projection that are valid for the upcoming quarters. But the dotted line is what is an intermediary projection that usually we don't share. And this time we we thought it was a good idea to share what we were thinking just before the conflict started. And we were somewhat optimistic because of some momentum which were built at the end of last year and the beginning of this year, especially related to AI, and so what we see now is this conflict. What we thought it was something like 0.3 up to 0.3 percentage point lower growth for the coming quarters, and some convergence back to the old path by the mid 27. And so this table is to show you what were the projection we published at the end of a month ago. You can see arrows, so the direction of revision compared to projection we did in December 2025. So maybe you would be surprised that there's not more negative revision compared to last December. But as I said, at first we were actually seeing some positive momentum built for global GDP growth, and the conflict ended this momentum. And so all in all, it's where we did revise our projection significantly was for the euro area, as you can see in 2026, and Korea, UK, and for the US we did revise up actually our projections compared to last December. Regarding inflation projections, this time there is a clear direction of revision compared to last December, which is a revision up. And this is happening everywhere. And clearly it's a consequence of the rise in energy prices. If I go now more in details about what has happened recently, and just to start with a slide where we see the change in commodity prices for some commodities. And so it's basically to show you that the impact of the conflict is not only about oil or gas, but other products, other commodities have been affected as well. And we focus usually a lot on fertilizers as well, also some of components of fertilizers. And I don't have the prices for everything here, but for instance, to give you another example, for instance, helium is a product where the Middle East is actually responsible for about 40% of global supply. So the current disruption is having a big impact on this commodity. And but as well, as you can see at the bottom of this slide, is that some other products have not seen a big change in prices. This is, for instance, the case for the gas in the US, but as well, food products, for instance, so far have not been so much affected. This slide is, after having talked about the prices, is about the supply disruption. And two examples on the left-hand side is about the number of vessels per day going through the Hormuz Strait. And clearly you can see that this has dropped a lot. And so far in April, we don't see a recovery, and it's still very, very low. And this will have an impact, especially if it continues for a long while. On the right-hand side, you see as well commercial flights. And even though there is some recovery, which we are still way behind what was happening in February. still, what we see is that financial markets are not having a big. They don't expect this this level of prices to remain at this level very long. This slide has not been updated with the latest. I mean, the latest is 16th of April, but even if you look at a more recent point, I had a look a couple of days ago, and it's still the same pattern. So you have sort of a peak for some weeks and then a gradual decline. And this is exactly what we have assumed for our interim economic outlook projection. So a certain decline in prices beginning in the middle of the year. And as I said, before this conflict, there was some sort of momentum built for the global economy. Here I'm showing the difference from the sort of indicator of output for services and manufacturing, the two first bars of this chart. And the red bar is about the level in February, and in green, the evolution which happened in March. And clearly you can see that the positive momentum has reduced a lot. This is the information for the global economy. And I don't have yet the value for April, but we already have seen the result for the Eurozone, for instance, which is again a strong reduction in the output as surveyed by the Purchasing Managers survey. And the last two bars in this chart is about the input prices, and again, this is expected, but we clearly see it with this survey that the input prices are expected to increase a lot. This chart is again about inflation. So in this case, it's a daily database based on millions of products sold by online retailers. And so the blue line is the average of evolution of prices between 2010 and 2025. The green line is what happened in 2022, because we know that was the year of the surge in prices with the conflict in Ukraine, and now we have this new line, which is the range line for 2026, and maybe some of you could be surprised to see that actually we are actually looking at some path which is very similar to what happened in 2022. And so we are, and we know that inflation has a lot of impact as well on consumers. For instance, on when consumer confidence is affected, we have private consumption which is affected, and so on. And let me talk now about financial conditions. This is an OECD summary indicator, which is based on, it's actually a composite indicator based on financial data. We do one index per country and then we aggregate. So you can see as here a comparison between the emerging market economies versus advanced economies. And maybe if we'll just look at what happened in the latest periods, is during 2025, starting maybe from the middle of the year, financial conditions have loosened quite a lot, and they were very accommodative for a long period. And again, that was related to what I said before. I mean, we were quite positive before the conflict started, but very recently we have seen that the conditions have tightened a lot. For instance, the volatility, which is one of the indicators we use, volatility has increased a lot, and this has tightened the conditions. Maybe a couple of words on the labor market, just to talk about the OECD aggregate. So what happened for when we look at the 38 OECD countries in aggregation. And if we start with the latest set of bars, what happened for the people above 15, we can see that the evolution between the fourth quarter of 2024 and the fourth quarter of 2025, we haven't seen a lot of changes. It's basically flat. If we look at the composition by age, the younger age group is clearly more affected with unemployment rate rising, and while this is clearly compensated by the older workers, which are now participating much more to the labor market. And so all in all, there's not a big change. What I wanted to talk to you today as well is about artificial intelligence, even if we don't have all the answers yet, but at least we can start talking about it. And maybe starting with the labor market again, just as a link with what I just said. And here in this case, we're looking at the job vacancies, and this is actually the yearly change up to March 2026, where we look at what happened in sectors which are exposed to artificial intelligence. So, for instance, professional services or real estate, for instance. And we compare the job vacancies in those sectors compared to the rest of the economy. And so far, we don't see job displacement. So it doesn't seem like people in the AI exposed sectors are more affected and now losing job. A notable exception, as you can see in this chart, is the USA, where we see clearly the AI exposed sectors being more negative than the rest of the economy. What we have seen as well in the US is higher productivity in the AI in the sectors where they have a high adoption of artificial intelligence. And so no job displacement, but clearly what we have seen is a rise in AI skills demand in the job advertisement. That's clear. So artificial intelligence again. So here we look at the industrial production, and clearly what we see is some economies are increasing a lot their production in this sort of technology sector. And this is particularly the case in some Asian economies. And in the US, I wanted to make the link with this chart, which is as well another way of looking at this importance of the technology sector for AI, is the AI enabling trade. And again, as you can see, over Asian emerging market economies are strongly affected, are having a lot of dynamism in this trade. Artificial intelligence is another way of looking at it is a sort of capital expenditure, and this is what you can see in the left-hand side. And so what has been spent by in blue bar by the Magnificent Seven, and other AI companies are the green bars. And even the plans, which are shown with an asterisk for 2026 and 2027, you can see that a lot of capital expenditures are in the pipeline. And that said, the lines are showing the sort of capex to earnings ratio, and we see that it's not clear that there is yet a lot of there is some risk attached to this rise in capital expenditures, and on the right-hand side, this is again something about the financing. And this case, I wanted to highlight as well some risk attached to the financing. As you can see, the red and green bars are rising, and this we know these are the private credit and private equity source of financing, and we know that they tend to be more opaque, and so AI is clearly a source of growth currently, but we are monitoring the risk attached to it, as there's a lot of money involved and in this sector. A couple of words on China. First, to talk about, on the left-hand side, the stability of GDP growth, which has been quite impressive. But a lot of things are going on in the economy behind this stability. As you can see on the right-hand side, the trade has been relatively robust. And despite, for instance, a lot of tensions with the United States, especially, but the Chinese economy exported still a lot of their products, and this was the case especially to other Asian economies, but as well to Europe. Just checking I'm not forgetting anything, but as I said, this stability of growth is as well hiding a lot of weakness in the domestic economy. So the external sector was supporting the economy, but the domestic part was much weaker, and basically we have this real estate sector which is still contracting, and we actually expect this contraction to continue at least in the near term. In terms of investment, the entire involution program is something we think that will weigh on investment as well. On investment, we expect a lot of infrastructure investment to start again, with some mega projects coming in the next few years. And maybe on the left-hand side as well, I wanted to highlight the fact that in China as well, this sort of high-tech industry is booming. And as you can see with the blue line, which compares the industry value-added growth for the high-tech industry compared to the whole industry in red line. And so the high-tech industry is booming, and we think that that will support exports in the next. As an outlook for the next year and two. The right-hand side is to mention the prices, because China has been in deflation for several years, and what we've seen very recently is the producer prices, which are back to a positive territory. We don't know if it will last, because it's clearly linked to the energy prices, but maybe some end to very low prices increases. A couple of slides now on risk. As I mentioned, our interim economic outlook assumes some moderation of commodity prices starting in the middle of 2026. And basically, we had something like 40% increase of oil in this projection in the baseline that I showed you earlier. But so in this slide, we wanted to build a scenario where commodity prices are increasing much more, like something like 100%, for us, at least. And that the prices will remain higher for longer. And in this scenario that we build, clearly we see an impact at the global level. So if you look at the left-hand side, the real GDP at the world level will be impacted by 0.5% in the second year following this shock, compared to its comparison with what we showed you earlier. And in terms of decomposition, you can see that it's especially Asian economies which are affected by this shock. And non-OECD are much less affected. Reason is actually because this is hiding two sorts of non-OECD countries, in a sense. Some are energy exporters and so are benefiting more from this surge in prices. And on the right-hand side, this is about the consequences on consumer prices. So clearly, again, at the world level, we have an increase of nearly 1% in the second year, with the non-OECD particularly affected this time because they account a lot of, they have a higher energy intensity in their production. And second reason is that one commodity that we have, what we are increasing is fertilizers. And this has an impact on food prices, and food prices is actually having a lot of weight in the consumer basket for in non-OECD countries. So this is one important risk that we highlight in our economic outlook. Yeah, okay. So talking about this food, as I said earlier, we haven't seen yet a lot of increases in terms of food prices at the global level. What we have seen so far is an increase in fertilizer prices. And so we do expect some increases in the food prices in the remaining part of the year. And it's always difficult to compute exactly how much it will contribute, but at least we know that some inflation will come from that. And so this is important to keep that in mind. A risk I wanted to highlight as well is the sort of financial risk. On the left-hand side is about the sovereign bonds, but bond in general, the yields are increasing and it has an impact not only for government, but as well for corporate sector, because a lot of corporate debt is high, so this, when the yield is increasing, this is important for them for refinancing and so on. And on the right-hand side, this is something I mentioned earlier as well, is some measures of volatility in the financial markets. And recently we've seen a surge in those measures of volatility. And this makes investors very sensitive to any news and information coming out. Let me have some words on policies, and just to highlight at first what we have observed. What we have in terms of at the OECD level is a sort of a weakness in the labor productivity. And in this chart, we look at periods starting from 1995, and clearly the light blue is labor productivity, and this has weakened a lot. And we are particularly conscious at the OECD about the importance of this. And I mean, the OECD is focusing a lot on the structural policies, and this is one of the starting point of a lot of work we do. And for instance, there was a recent publication which is labeled Foundation for Growth and Competitivity, and where we highlight recommendations at the country level. And one of I mean, when we look at them, it's basically a lot about product market regulation, which are usually too tight, and insolvency regime, which are usually not helping, not helping enough, and human capital, for instance, as well, are important policies that should be promoted. This slide is having this chart on trade restrictions. And this is as well one of the worry at the OECD. And I heard earlier as well that you are as well kind of concerned about sort of restrictions going on in the world. And here is an indicator made by the WTO, and which is summarizing the number of measures which are restricting imports. And as you can see, there's a lot of there's a tendency to increase this number of restrictions. And in the context of the conflict in the Middle East as well, the OECD is clearly insisting that there should be no restriction in terms of oil or gas or any energy or commodities related products could exacerbate supply disruptions. And one other room for improvement in the longer term is to reduce the reliance on fossil fuel. And this for a set of countries, the sort of different source. The total oil and gas imports in percent of GDP. And so you can see, for instance, Korea and South Africa or India importing a lot in terms of their GDP, and then this total oil and gas imports is decomposed into the source and the origin of these imports. And the brown bar is actually the importance of the Middle East, and then the blue is the OECD exporting countries, which are Norway, Mexico, Colombia, Canada, Australia. And then the rest of the world is a gray, white, light gray bars. And so one important aspect of reducing the exposure to geopolitical risk is actually to reduce the reliance on fossil fuels imports. So this slide is about this. And here, this is to show you the expected policy rates that we have in our interim economic outlook, and for the major economies, and clearly some divergence if you look, for instance, among the advanced economies between Japan or let's say the UK or the US. I mean, Japan is in a path of increasing its policy rate. And for emerging market economies, Brazil, for instance, is standing out compared to other economies. An important aspect for this is clearly that central banks needs to be very vigilant and react as inflation evolves, and the purpose of that is actually, especially to have inflation expectation to be well anchored. In this slide is something we have recently done, which is a tracking of energy measures, which has been taken since this conflict in Iran has started. And it's again because we are monitoring and following what is going on, what is happening at the country level, and how the governments are reacting against this calming inflation increase, and what we highlight at the OECD is the importance of having measures which are temporary and well targeted, and as you can see here, the green part is when they are both temporary and well targeted, and it's only about 20 to 25% of total measures. So we consider it's not enough, but so we are urging countries to pay attention to this, and especially in a period where fiscal policy is very under a lot of strains. And this slide is exactly about this fiscal position. This is showing the government debt in percent of GDP, and comparing what was the situation in 2007 and with a very recent update during 2025. And for almost all countries, this is an increase, Turkey being an exception. And now the level of the debt in percent of GDP is reaching a very high level for many countries. And this is especially problematic when we consider the medium-term challenges that all countries will be facing. Let's think about, for instance, population aging, which automatically will increase spending. And we have the climate change mitigation as well, where clearly this is something where the government will have to spend monies on. And another objective of public policies, recent policies, has been as well defense spending, and all of that, given this fiscal position, means a lot of tensions. And a lack of room and lack of fiscal space when there's a crisis, basically. And so this is my last section, where I'm just gonna talk briefly on defense spending, and then this slide is about the rise of defense spending for OECD countries. And as you can see, with the change from the green symbol to the blue symbol, is some countries have actually very rapidly increased defense spending. This is especially the case in the Eastern Europe countries, but I mean, this is kind of a general change. This is less the case in other countries where we've seen a stagnation. But we have we are now having yes, I'm just gonna go now to the last slide of this presentation, and where we see the comparison of a few countries with the NATO target, which is 3.5% by 2035, and clearly what we have is some countries increasing, continuing to increase their spending, like Poland, which is basically already at target. We've got countries like Lithuania, Latvia as well, Estonia, I think will have reached the target this year. And so in terms of effect on the economy, what we expect is actually not a lot of impact on the actual output, depending on the situation, depending on the economy, but we don't have a lot of very high multipliers, fiscal multipliers for spending. And but we have to keep in mind this is not actually the first purpose of this spending is not to increase output, but it's actually for security reason. So this is important. We still think that because there's a lot of spending at the same time, there is some effect that can be boosting GDP in the short run, but it depends on the amount of spare capacity in the economy. And in the longer term, this is clearly depending on the capacity to increase the production of the economy and to boost innovation. And I will stop here.
Thank you very much, Mr. Ollivaud. Are there any questions from the floor? Can we have the microphone, please?
Thank you very much for your presentation. Obviously, it covered a lot. One thing I noticed that on the US economy, you were very optimistic for the projections that you have. Why do you think that the inflation will come down in 2027 in the US, and why do you think the gas prices are going to go down? We all thought that the inflation probably will go up in US, not go down.
Okay, thank you for this question. In the US, inflation, yeah, I mean, a lot of this slowdown is about. I mean, we have seen already in the recent quarters some slowdown, which I mean, US was clearly one of the countries where we were still at above the central bank target before the conflict, but there was some slowdown in the price evolution. So we have in our projection we have an increase at first because of this energy spike, but then as a commodity price we expect inflation to come down. I don't think there is. I think we have basically this monetary policy where inflation. I mean, we don't have a lot of. I mean, the interest rate remain at a relatively high level, something relatively close to the neutral level. So, in the medium term, in these circumstances, medium term, we should be back to the central bank target, basically.
Thank you. Any other questions?
Good morning. I would like to ask about the effects of artificial intelligence. So, considering that the developed countries will integrate these technologies firstly, in the first phase actually, in their markets, do you expect the unemployment rates to peak firstly in these countries or in developing countries? And secondly, as you know, different solutions are discussed about preventing the effects of unemployment in the world, such as universal basic income. Do you think that these solutions are applicable, considering that only 2 countries are developing these technologies right now, like China and US, basically? And do you think these solutions can be effective in the end? Thank you.
The first question, it was about the interest rate, huh? I was not sure.
I was asking about the artificial intelligence again. So I understand that the developed countries will integrate artificial intelligence much faster than the developing countries.
Okay.
So in that case, do you expect these countries' job markets to be affected quicker, or also developing countries in the first phase?
Okay.
Thank you.
For artificial intelligence, this is something very new, so it's very difficult to be very affirmative about what will happen. This is important to keep that in mind. What we've seen, I mean, what we know is that there is a lot of development in I mean, clearly the US and China are now the leading countries in terms of artificial intelligence, but we can see as well some other developments in other economies, and there is a big risk for sure that there is some divide. I mean, you mentioned the sort of division at the country level, but even inside countries, there's a lot of debate about who will benefit from artificial intelligence. Will it be only a part of workers, or will it be shared equally? That's a lot of question. At this stage, we don't have a lot of answers, I have to say, and developing countries, there is a risk, that's for sure, but I cannot say more about the consequences, that I have to say, on this divide. And the second question, I think, was more or less, I think I replied as well, I think more or less, was... Sorry?
Universal basic income and
universal
similar
income
solutions.
At the OECD, we are not in favor of a universal income based. That said, we are clearly favoring a sort of regrouping of aids and supports, and so I mean, there's some reason behind it, but it's because of the complexity as well of implementing such model. We are not in favor of them. But again, grouping, making the system more efficient, and in addressing the different issues is something we are in favor of.
Thank you very much, Mr. Ollivaud.
Okay.